Hello again, everybody. Dr. Richard Smith here with Cycles TV, and good to be with you all again this week. Boy, the conference is heating up, and very excited. Lars and I are working hard. We're going to be having some major reveals at the conference, along with just a mind-blowing lineup. After last year, I really thought we were not going to be able to achieve last year's heights, but I was wrong. I'll admit it. This year is shaping up to be even more mind-blowing than last year. Last year, everybody was just happy to get together to say cycles are still alive. And this year, everybody's outdoing themselves, I would say, to not only prove that cycles are alive and well, but that we can advance a knowledge of cycles and a practice of cycles in ways that haven't been done for a long time. So really excited about it, and thanks for your patience while Lars and I have been heads down along with all the other presenters, really getting our stuff together. So Cycles TV has suffered a little bit from not having our full attention, but believe me, the payoff is going to be incredible and well worth it. So I'll go over the agenda in just a minute. We released the full agenda for the conference now, so we'll take a look at that. And then today, I'm going to be just revisiting some of the work I did last year and early this year, especially looking at kind of how the financial system works today, especially in light of some of the incredible insights that have been being revealed lately here. Let me just get some of these noises off here. I'll revisit the Tidal mechanics briefly, and then again applying them to markets. And I have a lot to say about this. I'm not going to spend as much time on it today. Believe me, the conference is going to be a game changer, but wanted to just review some of the things that we've been watching for, our theses about how markets are working today. And a huge part of that is the idea of treasuries as collateral, particularly short-term treasuries. What's going on with the Fed's balance sheet? What's going on with liquidity, et cetera? Where are the red flags? When are the red flags going to be a problem? And just, taking your requests as to what you would like to look at and doing a little more traditional cycle analysis today. So let me dive in, and bear with me because my head's spinning as much as anyone's, and looking forward to sharing some of this with you. So let me just jump back over here. We're going to start. Make sure I can see everything. All right. So cycles.org/cycles-in-the-city, where you can see Cycles in the City 26. And we've now released the full agenda. So myself, Cyclics, the science of cycles, really excited about this. We've got Michael Howell talking about the debt liquidity cycle. Ian Mackay, tidal planets, do Venus, Earth, and Jupiter shape the cycles of the sun and the economy? Chris Carolyn of the Spiral Calendar, so lots on tides. I'm not the only one. Seasonality signpost, Janne Miettinen, again, joining us from Finland, hormonal cycles and the fourth turning. Janne and I did some great work together, and it continues to really bear fruit. So very excited to have Janne with us again. Ray Tomes will join us remotely to share some really remarkable research out of Russia that he has been very instrumental in bringing to the light of day. So he's excited to share that. Of course, Lars, cycle consensus scoring, I'll show a little bit of that today. It's in beta right now with Lars and myself. Let's see here. Where are the other? Oh, right. So you can go to day 2. Larry Williams, Jake Bernstein, Bill Cerubi, Andy Pancholia, Gil Patel, Ron William. Wow. And the VIP dinner at Smith & Walensky. This was incredible last year, and it's going to be absolutely as good and better this year. We got Elliot Prechter joining us from the Prechter family, and John Bollinger, my history with cycles on day 3. Tom McClellan. Now, I'm really excited about this one, using insights from physics to understand market cycles. Harry Dent is joining us. Cycles are best understood in hierarchies. Stan Harley, Mr. Market Kinematics. Lars again, and Peter Borish in conversation with myself, Trading Traps, in conversation with Dr. Richard Smith. So, wow, it's just going to be an unbelievable gathering. Only 100 seats in the room. 20 of those are going to be filled with the presenters. You know, I mean, they'll be your peers at the conference. So I really hope everyone can join us. It's going to be an incredible event. And, you know, these recordings are not made available to the public afterwards. This is not something that we're selling the recordings later. This is be there in person to advance the work of cycles and to learn stuff that you just are not going to learn anywhere else. All right, so with that, let's revisit. Let's see, where do I want to start here? I actually want to start here again today. And again, this is about starting to see cycles in a new way. So we've been studying how the tides work, particularly over the monthly cycle. Every 14.8 days, you get the spring tides, or the highest tides, and the neap tides. So spring to neap are the low tides, back to the spring tides every 14.8 days. So that's, you know, new moon to full moon. And then full moon back to new moon is another 14.8 days to give that 29.6 day cycle of, you know, spring, neap. And we can put this on slow, and we can just see how the moon and the sun, right, their gravitational magnitudes there, right, now they're amplifying each other when they're in a row, right? And then over time, they start to get into opposition to each other. The sun starts to drag on the moon's gravity, to oppose it, to be in an angular opposition relationship with it. And gradually those tides get a little lower until the sun is at a 90-degree relationship with the moon, which on this chart you see as a reverse. We'll see when we get to the neap tides here. And almost there. And boom. Right, so here we see the sun. The sun's gravity is opposing the moon's gravity, and this is actually when they're in a 90-degree relationship to each other, but the way it's represented here, because is pointing in the opposite direction, meaning opposing the force. And that produces the lowest of the tides over that 14.8 day period, okay? So this is another view of the same thing here, but here, down in the bottom here, we have the blue line is actual tide measurements, daily tide measurements from New York Harbor. And then the gold dash line here is the interaction of the sun and the moon, gravitational pull of the sun and the moon. And you can see it's not lined up exactly, and the amplitudes don't match exactly, right? So the sun and the moon aren't perfect predictors of the tides, but it's fun to watch this kind of through time. Then you can see, like, you get into the neap tides over here, right? And then you're transitioning back to the spring tides here, where you get the highest tides. And let me see if I can find a good example here of what I wanted to show you. So now we're getting into the neap tides again. And then the spring tides. All right, so I didn't actually, let me see if I can find this manually. All right. Neap. All right. Not actually finding it. Okay, well, here's a decent example. Not as dramatic as I hoped, but see how, here where the spring tide was back here. Okay, and we're actually out of the spring tides now, over into this transition period, yet we have this higher tide here. This is actually a measured tide, and it's not, going down every iteration, right? This is a storm surge of some kind or another. So, the tides are not completely controlled by the sun and the moon and the gravitational forces. There are other events in the life of the ocean and of the harbors that influence the tides, not just gravity. There can be storm surges as a good example of something that is kind of an exogenous event. In physics, they call it a forcing function that disrupts the predicted outcome from the cycles, right? So war in the Middle East, right, is a forcing function that the oil market, we've talked about this a little bit, may have some cycles in it, some oscillations that it goes through. But when things happen like a storm surge or like war, those disrupt the cycles. Okay. So I think that's another good illustration of how we can start to think about cycles differently and how they manifest in our world, and how they interact not just with the oscillations, but with the events, exogenous events in that disrupt the cycles. So I just wanted to share that additional little insight from thinking about the tides and tidal mechanics and how the sun and the moon interact in order to produce the cycles, and then how the cycles can even get disrupted by other events. All right. So with that as preamble, and as we continue to think about what's going on in our world today, how can we understand here is the US dollar. Okay. We talked a lot about treasuries as collateral for the global financial system, and especially short-term treasuries being more or less fungible for dollars. And we can certainly see here in the cycles in the chart of the dollar, this is weekly data on the dollar, that we have a very clear cycle here, the 125-week cycle. Okay, so that's about 5 years from bottom here in 23 to a bottom here in 26. So no, sorry, because it's about 3 years, three plus years. So 125. Yeah, of course. Don't know how I got 5 there. So the dollar is, we followed this for a while, and it continues to look like it's making quite a constructive bottom here, and likely and also with increasing momentum and a CRSI buy signal. So that continues to be quite intact of prospects for a higher dollar, not the end of the dollar, but a higher dollar. And if we look here at some of this new indicator that we will be, it's still in beta right now, but we'll be focusing on at the conference as our new reveal and people will getting access to at the conference, showing that the dollar is in an extreme bullish condition across its major cycles right now. In fact, if we look at the cycles here for the dollar, particularly the 125 and the 212, even this 364 right here. Okay, if we get off all these, oops, it's jumping around a little bit for some reason. This 364 is about the only bearish cycle in the top cycles on the dollar, and it is actually coming into a bottom with constructive bullish momentum, which is why it really isn't getting the negative score in the consensus score. So the dollar looking extremely bullish on the whole and continuing to be the case. So here are some other things. This is the SOFR rate, the standard overnight financing rate for the Fed, right? It's not for the Fed. This is a market rate. The SOFR is a market rate. If you want to borrow money and use your short-term treasuries as collateral, you're going to get about 3.63% annually as an overnight rate. And we contrast that with the Fed IORB, interest on reserve balances, which the Fed doesn't have very much in terms of reserve balances right now. But if people were parking money at the Fed, they'd get about 3.65%. So the difference between these 3.63, 3.65, there's really no difference right now. So no big red flags there in terms of concerns about short-term treasuries as collateral. In the past, we've also looked at the MOVE index, which is the bond volatility index. And we clearly had a big spike here right into the war in the Middle East, building up to that, right? But it has come down dramatically now, along with, as we all know, the stock market going up dramatically. So hasn't made new lows yet, but boy, it has come down fast and hard, and complacency is starting to set back in the bond volatility. Momentum is falling rapidly. So are we going to get new lows in bond volatility? I would not be surprised, frankly. Right now, that's headed down. Certainly haven't made any new lows yet, but momentum is sharply down, and we'll see what happens. Similarly, these high yield option adjusted spread indexes, another metric of I'd say credit volatility, right? So absolutely had a big move up, but momentum's coming down. These are coming back down to close to their lows again, not quite there, but we'll see. And if we look at some of the cycles, looks like the bearishness could be coming to an end, but momentum is not rising yet, still falling sharply. So all of these are kind of going along with the fact that in the stock market here, S&P 500 basically new all-time highs. And if we do look at some of the cycles, Okay. Pretty bullish looking. And if we put our cursor over the latest data point here, you can see all the top 3 cycles are all in the green. We do have a couple of cycles here that are not in the green that are also on the strong. We can take a look at those for the S&P 500. Okay, this 343 in particular is still pointing down, but so far momentum is not has not reversed here. And we can look here on the spectrum, 343, we can see it's not nearly as clear on the spectrum as, say, this 193, but particularly this 123 and this 78. So to kind of get to the Fed again, here is the Fed balance sheet, the weekly balance sheet, right? Reached $9 trillion back there after the COVID crisis. And then we've been having this quantitative tightening here from May of 22 into December of 25, where the Fed has been reducing its balance sheet, right? Not buying as much treasuries or mortgage-backed securities and letting some of that roll off. But we know that that has created some tension around the idea of, the Fed, can the Fed afford to continue quantitative tightening? And indeed, they have eased up on quantitative tightening. And if we zoom in here, we can actually see that they've started quantitative easing again. And if we do look at all of these cycles, if we put our cursor over the last data point of the Fed, I don't think I've ever seen this before, where every single cycle is green. Every single cycle's bottoming. So that's telling us that, this quantitative tightening has overstayed its welcome, and the Fed, there's pressure on the Fed to ease, big pressure. And we can look at the CRSI, right? Even just on the strongest cycles, turned up sharply. So meanwhile, so that's very interesting. The consensus index, again, this is in beta testing with myself and Lars. I'm going to be releasing it at the conference, talking about it more there. You're not going to see it on your own charts yet. But extreme bullish for the prospects of the Fed stopping quantitative tightening and possibly continuing getting more aggressive with quantitative easing, at least not tightening as much. So meanwhile, there's something interesting I want to show you here, which, we have the Fed easing here or tightening, not buying as much treasuries, and yet treasuries have held up pretty well, right? So what I wanted to show you here is, so this is from Fred. And let's just look at 5 years. So this is money market funds, total financial assets. So if we go here from 2021 to 2025, total money market funds have gone from I think these are thousands, millions, right? So 5 trillion up to 8.1 trillion. So up about $3 trillion. Whereas when we were looking at here from 2022 down to, what did we peak at there? 9 trillion, coming down to 6.7 trillion. So that's 2.3 trillion in quantitative tightening from the Fed. But while that's going on, sorry, here it is. We have an increase, say, from 2022 here to 2025. This is in quarterly data, not weekly data, of, surprise, surprise, $2.4 trillion. So what does this mean to us? Money market funds, what do they do with their, when they take in dollars, what do they do with them? They buy short-term treasuries. So basically, short-term treasuries have not been being purchased as much by the Fed, right? They haven't been repurchasing them. They've been letting them roll off. But all of that slack has been picked up by the money market funds. So I bring this up as a thesis about kind of market tides, right? The moon and the sun, the Fed and money markets. Buying treasuries as collateral in the global financial system. Treasuries basically fungible with the dollar. The dollar looking quite bullish. Let's see if I can get this back here. There we go. And not really seeing crises in the indicators we started tracking, including the standard overnight financing rate versus the Fed's interest rate on balances, the MOVE index, and the high yield option adjusted spreads. Yes, we had the storm surge of the war. You can see it in the stock market coming down, but now we're at all-time highs again, and the cycles are quite constructive and bullish. Dollars, bullish. Volatility is coming down, okay? And even though the Fed was tightening, money markets were picking up the slack in the treasury market, and now the Fed has stopped tightening and is loosening, easing. All right. So that's the picture as best as I can make it out right now. And just summing up, starting to get a better idea to look for interactions, just like the sun and the moon influencing the tides. How do the Fed and money markets influence support of treasuries? And not just money markets. We've talked about stable coins in the past too, growing that market. And what do they have to do with stable coins? Buy treasuries. Thank you, Congress. So these are the things that are governing the global financial system and the liquidity in the markets. And yes, there are forcing functions, there are storm surges, but we have to keep an eye on the underlying repeating oscillators and study the markets through the eyes, through the lens of cycles in this more geometric way. If I had one phrase that sums up what I'm saying, it's that geometry matters. You know, it's not all algebra. There is geometry in our world. There is rotation. And that's what has been becoming clearer and clearer to me every day. And now I've got the math to prove it. So I'm still working on how to take these new ideas and translate them into meaningful new indicators. But believe me, that work is going very well. And I'm excited to continue to share that at the conference with you, but also to share more of it in the weeks and months ahead, especially once I get through the conference. So appreciate everybody tuning in. What is the relationship of Walkel to the bonds? By bonds, do you mean the longer term bonds, like the 10 years and the 30 years? So, the Fed did buy not just short-term treasuries, they bought longer-term treasuries back there during the COVID crisis and mortgage-backed securities. And they've said that, they're going to let those run off and get their balance sheet more into alignment with what the Treasury issuance is. And the Treasury is issuing predominantly short-term bills, which doesn't really sound like a great what they should be doing to me, but that is what they're doing. So yeah, thanks, Mark. Appreciate it. All right. Well, appreciate everybody tuning in. And again, the conference is coming up. It's about a month away now, and the lineup is just incredible. It's going to be an unbelievable event. I hope as many of you as possible can join us. There really isn't going to be any place in the world to be if you love cycles. So great things to come. Thanks everybody for tuning in today, and keep an eye out for storm surges, but keep an eye on the underlying forces that will still be there when the storm surges recede. All right, everybody, have a great week. I'll hopefully see you again next week. Bye-bye.
Cycles matter because they show us the future. Nothing else shows us a future path. Nothing that I've ever found in over 60 years of doing this.
The foundation is bigger than markets, right? It started out bigger than markets. It's still bigger than markets. It's bigger than us.
There is no such thing as a black swan. It is merely a cycle that was not forecast or anticipated.
To me, it's huge. If I can get a glimpse of the future, just a little bit of the future, I'm way ahead.
I think that the Foundation for the Study of Cycles has a role to play in both bringing technology to the world, but also really emphasizing agency and human agency.